When you move beyond basic stock trading, you encounter two distinct paths: the high-speed liquidity of Forex and the structured complexity of options. Selecting a market based purely on which appears more profitable ignores the specific mechanics that generate those returns. Every market has operational rules that can either support or actively fight your schedule, risk tolerance, and psychological limits. Long-term survival requires matching your behavioral profile to the mathematical structure of the market you trade. Applying the logic of traditional equity shares to a highly leveraged currency pair often leads to rapid, unforeseen drawdowns. Similarly, buying a derivative contract without accounting for its expiration date can result in a total loss of investment, even if your market direction was correct. Trading accounts are rarely lost due to poor directional analysis alone. They are lost when a trader's strategy contradicts the market's inherent structural rules. Forex is a 24-hour market operating 5 days a week. It is a linear environment characterized by high liquidity and extremely small movements in currency value. This represents a 500-to-1 leverage ratio, controlling a massive position with a tiny fraction of capital. Microscopic movements in pips result in significant gains. However, a slight reversal against your position can trigger a margin call, instantly depleting your initial capital. Forex trading demands the emotional discipline to manage this uncapped risk through the strict use of non-negotiable stop losses. Options buying operates on a different logic. It is a vehicle designed for mathematically capped risk. These graphs compare linear risk to defined risk. In options, your loss line is fixed at the upfront premium. If the market drops sharply and your thesis is wrong, your loss is strictly limited to this premium paid. Your downside cannot extend past this floor. This safety net comes at a cost. Opening a single options contract generally requires more initial capital per trade than the spreads found in the Forex market. While options buying prevents a total account blowup from a single trade, it requires you to forfeit that capital immediately if the market fails to move in your favor. Unlike a currency pair, an options contract has a fixed expiration date. This chart illustrates theta, or time decay. Theta is the daily mathematical erosion of a contract's value as it gets closer to its expiration date. To profit as a buyer, you must be right about the direction of the market and the speed of the move. If the asset remains flat, time decay will eventually reduce the contract's value to zero. Time acts as a constant adversary for the options buyer, necessitating precise execution windows rather than long-term holding. The price of an option is also heavily influenced by implied volatility, or IV. IV is the market's expectation of future turbulence. As expectation increases, the gauge rises and premium cost inflates. Buying during peak excitement often leads to IV crush. When the market calms down, IV drops, collapsing your contract's value even if the asset hasn't moved. Options are a multi-dimensional puzzle. Being correct about market direction is insufficient if you purchase the contract at a volatility peak. Forex is a directional market. Profit is entirely dependent on correctly predicting whether an asset will move up or down. Options allow for more strategic variety. You can build positions that generate returns even when the market is moving sideways. This is an Iron Condor, a multi-leg strategy where you combine several options contracts. This creates a specific profit zone where you succeed as long as the price remains between these two boundaries. These multi-directional tools offer more flexibility than Forex, but they require a significantly steeper learning curve to master the underlying derivative mechanics. Options provide deep strategic adaptability for traders who are willing to manage the technical complexities of the Greeks. This framework maps specific behavioral profiles to their ideal market environment. The first profile is the active scalper. This person has flexible daily screen time and high emotional discipline while managing rapid price changes. The scalper is best suited for Forex. The 24/5 liquidity allows for rapid compounding, provided they use tight, disciplined stop losses to control leverage. The second profile is the strategic planner. This person prefers to trade around specific events and needs to know their exact maximum financial exposure before entering a trade. The planner aligns with options buying. They benefit from defined risk, though they must purchase contracts with enough time to withstand the effects of theta. Finally, the income generator is typically a well-capitalized trader seeking to collect yield from existing positions. This profile utilizes option selling. In this scenario, time decay becomes a source of profit, though it requires advanced strategies to mitigate the potential for uncapped losses. Sustaining a trading career depends on how honestly you evaluate your psychological limits against these specific market structures. Neither Forex nor options is more profitable by design. Risk is found only in misusing the tool or misunderstanding the environment. Investing live capital before you have mastered these mechanics often leads to avoidable losses. Test your strategy and your own psychological response in a simulated, risk-free environment before moving to live execution. Using the FXNX NX1 demo platform allows you to validate these market theories and refine your execution before committing actual capital.